The Canadian debt and housing bubble is at extreme levels. We are at a tipping point in this country. Canada has seen a housing bubble that's lasted for many, many years in several of its major cities. The amount of debt that Canadian households are currently carrying is, to put it bluntly, off the charts. Despite warnings from various organizations, both domestic and international, Canadians have an insatiable appetite to take on more and more debt, especially mortgage debt, to acquire houses at ever greater and greater prices. The housing market is completely out of balance and detached from any sort of economic fundamentals or principles. Now, to illustrate my point, we can first look at a chart provided by Bloomberg in recent weeks, which illustrates how since the early 2000s, household debt has ramped up, literally ramped up. And in particular, mortgage debt makes up 65% of all household debt in Canada right now. Canadian household debt exceeds $2 trillion. Now, to put that into context, the size of the entire Canadian economy is $2 trillion, roughly. In other words, the GDP of the country as a whole is about $2 trillion, which lines up and matches up pretty closely with the amount of household debt that families in this country are carrying. Now, here's another chart that just shows the ramp up or escalation in Canadian consumer debt, just to illustrate further what I was talking about. Relative to other G7 countries, Canada has really become more indebted relative to the amount of income that the typical person in the country earns. In 2000, Canada's household debt relative to income was 110%. In 2014, it was 166%. Well, currently we're at about 169% in terms of the ratio of household debt to income, which is unprecedented. Compared to the US, we can see that the US sort of peaked in terms of its household debt to income ratio in the mid-2000s, which corresponds with the housing bust that took place in the US, let's say starting in 2007. And this chart shows you how families, individuals in the US began a deleveraging process around 2008, 2009. Canada, on the other hand, accelerated its household debt level. Instead of deleveraging, families here began to take on even greater amounts of debt relative to the US. So the US families there, in terms of households, did not take on as much debt, even at the peak of their housing bubble, where in terms of, compared to Canadians who are way beyond anything that the households in the US kind of spiked towards. Vancouver is the epicenter of, or has been the epicenter of, the housing bubble in Canada. This chart here shows you the price ascent of houses in Vancouver, which is on the west coast, north of Seattle by, it's about 2.5 hours north of Seattle. And the average detached price, looking at this chart, sort of touched 1.6, 1.7 million. Now, there's nothing special about that average price. That house that you're talking about is literally, it looks like a shack from the outside. That's typically what those houses look like at that price point. Now, Toronto seems to have followed in the footsteps of Vancouver more recently. Here's a 5-year view of what's happened to the average price of a home in Toronto, and you can also see that it's really ramped up and accelerated. Now, what is this all built on? Well, I'm going to argue that it's all built on debt, that mortgage debt is underlying all of this growth in housing prices. Because if you look at this chart, the rate of growth of average hourly earnings, it's not a surprise to know that it's generally stagnant. It's flat to even slightly lower in terms of real purchasing power once you factor in inflation. This whole bubble that we're seeing in Canada is built on an ocean of debt. And there will be a day of reckoning, and is just not sustainable. How can you have housing prices that, as a multiple of incomes, for example, are 10, 11, 12, 15 times the average or median household income, where the traditional rule of thumb is to have a balanced financial picture within your household, is to be at about 3 times, gross income. Now, granted, income or interest rates are quite low now, so maybe if we were generous and said, 5 times, 4 times median income is reasonable. Well, that still only puts, for example, the typical Vancouver home should be around $500,000, because the average family, to be generous, let's just say that the average or median family income is about $100,000, which it isn't. It's actually below that. You could rationalize that, but not at these prices well north of $1 million, when it's all just floating on debt. And the only thing keeping this thing afloat and keeping it going are artificially low interest rates, so-called emergency interest rates, which we've seen for a good 7 or 8 years now, when the emergency just never seems to end. So there's a lot of people complicit, in terms of creating this bubble. But you can bet your bottom dollar that there will be a day of reckoning, and this country is going to be in trouble, because residential real estate is the only engine of growth right now in this country. Our oil sector is down, mining is down, manufacturing has been hollowed out, and it isn't really recovering in a meaningful way. So if this is the only pillar holding up your economy, and it's really a house of cards, look out below. The Canadian debt and housing bubble is at extreme levels. We are at a tipping point in this country. Canada